Something huge is happening right now, deep inside the plumbing of global finance. One of the oldest ideas out there, debt, is getting a crazy 21st century makeover. And when I say biggest, I mean the absolute biggest. We're talking about a massive shift, where things like bonds and loans are literally being rewritten onto the blockchain. And this isn't some far-off, maybe someday thing. No, it's happening right now. And if you need proof, just look at the headlines. When a name like State Street teams up with a giant like JPMorgan on a project like this, well, you know it's the real deal. So just how big of a deal is State Street? They oversee $49 trillion in assets. To give you some context, that is more than double the entire GDP of the United States. So them getting involved isn't just dipping a toe in the water. It's a massive cannonball splash that the entire industry is watching. All right, so let's dive in and take a closer look at what these giants are actually up to. So JPMorgan has built this whole system called Connexus, and it's designed specifically for trading these new digital debt assets. Now, State Street has jumped in as the very first outside company trusted to actually hold or be the custodian of these assets for investors. And they didn't start small. They kicked things off by buying $100 million worth right on the platform. Okay, so we've got the who, but what in the world is tokenized debt? Let's break down what this term actually means. Really, at its heart, it's just about taking a traditional loan or a bond and turning it into a secure digital token. It's kind of like trading in an old, dusty paper IOU for a high-tech digital key that proves you own it, and that key lives on a super secure, shared database that everyone can trust. And this is where you really see the night and day difference. The old way is slow, clunky, full of middlemen, and takes days for a trade to actually settle. The new way uses something called smart contracts, which is basically just code that automatically enforces the rules of the deal to cut out a lot of those middlemen. And that means trades can settle almost instantly. That's a huge leap from waiting days to done. And the process itself? It's pretty logical when you break it down. First, you pick an asset, like a corporate bond. Second, you write all the rules, the interest rate, the due date, into that smart contract. Third, you slice up that debt into tradable digital tokens. Fourth, people can start trading those tokens, and the smart contract handles all the payments automatically. And finally, those tokens are stored safely in digital wallets, with the blockchain keeping a perfect record of who owns what.
So the big question is, why? Why are these trillion-dollar companies going through all this effort? Well, let's talk about the payoff, because it's pretty compelling.
I mean, the list of potential benefits is huge. We're talking about making it easier to buy and sell these assets, slashing administrative costs, creating a super transparent and secure log of every transaction, and opening up these markets to way more people. Oh, and of course, settling trades in seconds, not days. In that accessibility point, that's a potential game changer for regular people. Because you can slice a bond into teeny tiny digital tokens, it allows for fractional ownership. So someday, you might be able to invest just $100 in a high-yield corporate bond that used to be only for the big multi-billion-dollar funds. So is anyone actually using this stuff? Oh yeah. The market for just one tiny corner of this world, tokenized US Treasuries, grew by an insane 641% in 2023 alone. That's not just growth, that's an explosion. And if you think that's wild, just look at what the experts are saying. Boog names like McKinsey, Bernstein, and Citi are all predicting this will be a multi-trillion-dollar market in just a few years. We are literally watching a brand new, massive financial market being born. So who's playing in this new sandbox? Well, on one side, you have the issuers. We're talking governments, big corporations, and banks who are creating this digital debt. And on the other side, you have the buyers. That's everyone from giant investment funds to one day, maybe even regular folks and crypto fans who want stable returns. Okay, so this all sounds amazing, like the perfect system, right? More efficient, more open, more secure. But, and there's always a but, we've got to ask, is this a sure thing? Because, with any revolutionary technology, the road to becoming mainstream is always packed with some pretty significant speed bumps. And here are the big ones.
Nobody's really sure what the final rules and regulations are going to be. The technology itself isn't perfect. A bug in the code could be disastrous. The market is still brand new, and there isn't one single standard for how this all should work. Plus, a lot of legal systems haven't even caught up to recognize these things yet. But the real monster in the room? It's regulation. Imagine you're a global bank trying to operate in a world where every single country has different rules, or maybe no rules at all for tokenized debt. It's a logistical nightmare. Figuring this out is absolutely critical if this market is ever going to reach its full potential. All right, so let's pull all of this together. We've seen the incredible, game-changing potential, but we've also seen the very real challenges ahead. So what's the bottom line? Where is this all really going? Look, if you remember one thing from all this, make it this. Tokenization is not just some niche crypto buzzword anymore. It's graduated. It is now a central piece of the strategy for the most powerful players in finance. They don't see it as a trend, they see it as the actual infrastructure for the future of their markets.
And that leaves us with one final, kind of mind-blowing question. If the world's biggest and most important bonds are already moving onto the blockchain today, how long is it before the debt in our own lives, our mortgages, car loans, student loans, does the same? The digitization of debt is here, and it might just change everything.